Great. So welcome you all to the question solving stage of IAS 38, Intangible Assets. IAS 38 talks about intangible assets. Intangible assets. That is it. Intangible assets. So that is IAS 38. Okay, so if I've not gone through already, can I use the previous lecture video to go through? Let's go straight to the questions. The first question is this. Okay. Great. Now let's look at this question. Delali Limited. How are you going to solve this? It starts from here. Delali Limited adopts a revaluation model for subsequent measurement of its intangible assets in accordance with IAS intangible assets. Now, the requirement says that we should discuss the accounting treatment required in the financial statements. So tell us what to go to the comprehensive income and tell us what to go to that of the financial statement, the balance sheet or the financial position. Okay. And telling us that the company adopts what? The revaluation model. Great. Now watch carefully how we go through this question. Now, the policy of the land is to revalue its intangible assets at the end of each year. An intangible asset with an estimated useful life of 9 years was acquired on January 1st, 2016 for 45,000 cedis. It was revalued to 54,400 on 31st December 2016. And revaluation software was correctly recognized, meaning it was recorded well on that date. After 31st December 2017, the asset was revalued at 32,000 cedis. Was the accounting treatment. If you see the examiner giving revaluation 2 times in a single question, I can tell you in advance that the examiner wants to test you on reversal exception. How do you treat previous gains and previous losses in revaluations? That is all. Okay. So now the accounting treatment. Something like this. I don't need to read everything, start line by line. So let's assume that you are solving this in the exam room. Even where you don't have any idea, it's a must. Look how you're going to answer this question. So first, tell the examiner solutions. Now with the solution, I'll tell the examiner that solution. Maybe it is question 2C. So question 2C. Let's see. We look at it. So please go by line. Just go by it. This question, the examiner did not manipulate it line by line. When you are solving it, you also have to solve by line by line. All of this was not like manufactured as a goal. No, it was typed line by line. So please and please again. So I'll start line by line. And be sensitive to figure and dates. I start from here. The policy of the land is to revalue its intangible assets at the end of each year. Okay. An intangible asset with an estimated life of 9 years was acquired on January 1st, 2016 for 45,000. So I'll go and write it. Our third examiner, cost of the intangible assets. Cost of the intangible assets. They told us that is 45,000. Yeah, you are reporting in cities. It can also be in dollars. So I'll put a 45,000 down. They also informed me that the useful life of this asset is what? Is 90 years. Agreed. The useful life of the intangible asset is what? 9 years. Immediately, I will check whether there's scrap value. There's no scrap value, then the good news. Whether they've asked me or not. Our third examiner, this is intangible. So we amortize intangible and we depreciate what? Tangible assets. Okay, so our third examiner, amortization for that particular year. That is in the bracket 2016, right? Okay. So amortization is nothing but the same as depreciation. So 45,000 divided by what? Divided by 9. That is amortization. So I'm not done with the entire question though, but I'm doing what probably I can do best though. Of course. So divided by that of 9 years. So that will give us 5,000. Then I will continue. So that's the depreciation for a year. If I need 2 years, that examiner. Therefore, accumulated depreciation will be this 5,000 times 2 years. If I need 3 years, this one times what? In that order. Okay. So don't forget about this trick. Line by line. Line by line. If you don't know where to start from, don't worry. Go by what? Line by line. Okay, so the next line. It was revalued to 54,000 on 31st December 2016. That day I can find the current amount. As soon as the examiner gives you a cost of an asset with a useful life and mention dates, kindly find the current amount at the date, whether valuation or transfer or sale took place. So kindly take notes of it. Okay, so we have to find the current amount as of 31st December 2016 immediately. So go to the board. Because we're going line by line, it will even set off nicely. If I take this, because it's just 1 year, I'll get the current amount of 40,000. So this becomes the current amount as at 31st December 2016. Third examiner with the date. So that is it. Now, there was a valuation at this date. I'll first of all find the current amount before I proceed. So let's assume the examiner quoted a date like 31st December 20, let's say 19. So I'll count from 2016 up to 19. So that will be 4 solid years. I'll count this and then multiply this one by what? 4. That'll give me the cumulated depreciation. So that is how we'll look at it. Okay, but here they did revaluation. So we should determine the revaluation gain. So let's determine the revaluation gain or loss. So just bring the revalued amount here. The revalued amount here. Revalued amount. At the same date, what is the revalued amount from the question? So from the question, the asset was revalued to the same day, revalued to 54,000 400. So that's the revalued amount or the fair value. So come here and put 54,400 in here. Determine the revaluation gain or loss of the revaluation. Yeah, clearly the revalued amount is more than the current amount. So there's a what? Gain or there's revaluation surplus. So tell the examiner that revaluation gain is 14,400. That is it. Perfect. Have you seen line by line? No. We've not read everything. No. Yes. In exams, if you meet any question you have no idea, and it is in accounting and there are figures inside, don't worry, you must pass. How? Line by line. You read first line, you summarize it down. It's a tick for you. You move the next line. You were summarizing this question, in fact, but that's the solution. If you follow line by line. At least, even if you don't get a final answer, you listen them here like this, you fetch you some ticks. And then the text will contribute to what marks for you. So take note of it. Accounting, most of them, we are not interested in the final answer. We are interested in those that can provide majority of the entries. Because if it will be the final answer, how to arrive at it. So take notes of that. Take notes of that. Okay, so that is that. Now let's continue reading. And before that, what is the accounting treatment of this revaluation gain? Tell me the treatment. Two treatments, 1 and 2. It will be added to the current amount of the assets. So added to the current amount of the assets. Into bracket, that examiner, that is a debit entry. The next one, added to the OCI or revaluation surplus account. Into bracket, that is a credit. Good. So that is the treatment. Perfect. Debit the asset and credit OCI. That is all. Move on. Good one. Then we move on. So you're doing this. All these ones are working. So let's continue again. And the revaluation surplus was correctly recognized and added. As at the 1st December 2017, they mentioned that it's something like that amount. Anytime they mention date, you have to stop and look at it again. The asset was revalued to 32,000. Okay. Now it means that we have to find the current amount as at that date. So we have to proceed again to look for current amount as at these days. This is the year in question. Usually, the year in question. Yeah, they made it 2016 and 2017. That's good news. So what goes to 2016? What goes to 2017? Let's see. So let's go to 2017 financial year. This is a summary for 2016. So 2016, that is it. So 2017, let's start. Round 2. In 2017, third examiner that we are going to calculate the revaluation gain or loss in 2017. So in 2017, calculation of revaluation gain or loss. Next, all what we have to do is this. We tell the examiner the revalued amount, what's the fair value? Revalued amount happen to be the revalued amount from the question happen to be 32,000. Perfect. So put the 32,000 down. We need the current amount after this date. So current value as at 31st December 2017. What is the current amount? Now, this figure, can you write them or pick them somewhere? I'll call for them. How do you find the current amount? The current amount is equal to the cost minus the accumulated depreciation. But here it is a revaluation method. So the current amount becomes the revalued amount less subsequent accumulated depreciation and subsequent accumulated impairment loss. Then after valuation, the asset value becomes the fair value. So the value of the asset as at 31st December 2016, we had 54,400. That is the value. So depreciation or amortization should be based on this value. This is the fair value, or this is a new value. After revaluation, the asset value becomes what? Becomes the fair value. So after valuation, the asset value becomes the fair value. So if I'm looking for current amount, I have to pick this fair value, which is 54,400, less the depreciation charge for 2017. Or if you like, you will pause here and go and do workings. That amortization for 2017. 2017 amortization is what? It's nothing by into brackets 54,400 divided by what? This time I divide by 8. Why 8? But not 9. Who can tell us the reason? It's gone. Because 1 year is gone, we have to use 8 years. So what is the amortization for 2017? Amortization for 2017, 6,800. Now the examiner, 2 treatments. If you're looking for the treatment, number 1, number 2. Even though when I'm done with this, I will summarize everything in the financial statements, the P&L and the balance sheet. Now looking at this, first you add it to your operating expenses. That is the debit. Second, you subtract it from the intangible asset. That is a credit. That is all. That is the treatment. Don't forget that the examiner said discuss the treatment though. So that's the discuss. Okay, let's find the current amount. The current amount will be the cost of 54,400 less depreciation of 6,800. So 54,400 less 6,800. What is the current amount at that date? 47,600. Okay, so that is that. All these things, they are workings. However, I can give you shortcuts for you to strike to get this figure so easy. But sometimes you need it, you can't go through the long process. Ask yourself, if you want to get this figure, 47,000, so easily, just tell yourself that this 54,000 times the number of life remaining, the years of the asset remaining, 11 what? 7 good years, all over 8. If you do this calculation, it should give us this 47,500. So that is the current amount of it. Okay, so that is it. Now let's see the answer. So this will result a revaluation loss, right? This will result a revaluation loss. Revaluation loss of, because the fair value or the revalued amount is what, 32,000, and then current amount is 47, so 15,600. Okay. What is the accounting treatment? This is where the issue is. What is the accounting treatment? We said that all gains should be credited to the OCI except if there was what? A previous loss which needs to be reversed. Great. In this case, we have a previous loss. Let's see. So it means that the accounting treatment will be, number one, once a loss, credit the asset account. Credit the asset once it's account, or subtract it from the current amount. Perfect. I'll take that. That was the next treatment. Okay, the debit operating expenses, with the exception of where there's no previous loss. Number two. Now, before you debit an operating expenses, make sure that there's no previous what gain. This one is a loss. So loss, check whether there was what previous gain. What we did under IAS system, the same thing we are going to apply here. So let's check whether there was what previous gain. The same asset, 2016, they had a gain of what? They had a gain of 14,400. And today they've incurred a loss of 15,600. Until this loss or this gain is cleared, they cannot tell themselves that they've made a loss. That is the accounting treatment. Okay. So this is what we have to do. So first, whatever this gain is, a portion of today's loss must be released to offset it. So first, we have to go there and debit what you call OCI. Here, you credit the asset with 15,600 entire loss. You debit OCI with what? 14,400. Then finally, you go to the remainder. You now debit operating expenses. Now debit, you can call it P&L or operating expenses with the remainder. What is the remainder? The leftover. So that is 1,200. So that is all. If you're able to go through this, you are fine. And then examine why. Because there's a previous gain. You can record all. Now let's look at the extracts, relevant extracts. For those who want to answer this question using the extract. Although you can provide step-by-step entry like this, and then provide the treatment in there. Now let's provide some relevant extract here. So I'll start what we've done, just a working. So if you're able to do this, at least you are done. Or alternative is what I'll come to do now. The alternative presentation. Tell the examiner that in the books of who, books of the Nali Limited. Let's record a comprehensive income here. Comprehensive income. For the year ended and the 3rd December, this is 2016 and 2017. So 2016 and 2017. Okay, so that is that. Third examiner, your currency, reporting currency in cities. First, depreciation. First on our right. But here to be what? Amortization. Not depreciation, amortization. So what is the amortization in here? Amortization figure. Amortization for 2016 happens to be 5,000. It is 6,800. Okay. So this is the extract. Now you go to, you leave a space, then you go to OCI. The OCI. In 2016, they did revaluation. They had a gain of 14,400. So that gain must hit the income statement through the OCI. So right here, revaluation was gain. Please let me be clearing this one small. You do have it, so let me clean it. So sorry. The right here OCI. The right here revaluation was gain. It was 14,400 for 2014. However, in 2016, we said that we are going to debit. We are going to debit 14,400 for that of. They had a loss of 15,600, and this loss, until this gain is cleared, they cannot lie to themselves that they've made a loss. So let's go and claim this gain. Wherever the previous gain is sitting in the books, kindly go there to reverse it. And this gain is in OCI. So that is why a portion of this loss must be released to cancel this. So come here and write the figure 14,400 here. I put it in bracket, meaning that the loss. So here you change the narration to revaluation gain slash what? Loss. Go revaluation gain slash what? Loss. So take notes. Revaluation gain or loss. And then in 2017, the entire loss is 15,600, right? So let 1,200. That 1,200 should hit the P&L as what? As loss. So we come here and record revaluation loss. Dash of what? 1,200. So that is it. You can put it in bracket. Okay, so that is the end of what? The comprehensive income. That's all. So this is what they are looking for. Let's do the financial position here. So this is a statement of financial position. No shortcuts, no items. So in the statement of financial position, 2016 and 2017 are reporting currency and currency. What goes in there? Here, intangible, you only write intangible assets. carry the fair value at the end of the reporting period, or fair value less accumulated depreciation and then the subsequent accumulated impairment loss. But because here the valuation took place the last day of every year, they will not have what you call the accumulated impairment or accumulated surplus or the accumulated amortization. No. So intangible assets over here, just pick the fair value, which was 54,400. And then for 2017 was 32,000. Okay, so that's good news. That is all. Then move on to the next section. Now go straight to the equity section. Any figure which hits the OCI must enter the P&L. So it must enter the financial position under equity. So under equity, write what you call revaluation gain. First year is 14,000. The next year will be dash as well because we have a negative 14,000 and we have a valuation gain of 14,000. It must net off. Okay, so how is that? So basically, that is the end of this question. That was our first question. If you have any question, can you ask? So that was the extracts and the financial position and the impact. Okay, so it's 14,400, right? Okay, so that is that. Thank you. Okay, so I think that is the end of this particular question. Let's scan through another one again. I do one, you do one. So now this is your 10. Tell me how to treat note. Note 7, research and development costs. So can you walk me through? Okay, so first, let's see. Research and development costs for the year ended 31st March 2019, which had been included in admin expenses. It added all the research and development costs to admin. Is that right? No. Development costs should be capitalized. Research must be expense. So if you have added research, fine. For development costs, now let's find the component which belongs to development costs and capitalize it. So, which will to a project to develop and product called your unit. It was completed this year. Composition is as follows. Research 5,000, cost 2,005. However, all these costs is in admin expenses. This is a trial balance here. There's a full trial balance in here. So tell us that. So just to examine that the research is okay. Let's maintain the research. But the development cost, no. If it meets. They said the auditors are satisfied that development expenditure meet the requirement of IAS intangible assets for capitalization. We estimated it like for 5 years. So all what you have to do is tell the examiner that this figure should be what? Capitalized. So in short, tell us the treatment. They have added it to admin. So the treatment will be this. Tell us that the treatment will go like this. Number one, subtract it from admin because that's not the position. That's the treatment of the development cost. Development cost. Number one, or A, subtract it from admin, meaning that we should credit admin. Then finally, B, add to intangible asset into bracket debit. That is all. And please, you know when to depreciate or amortize intangible assets, right? The condition. Condition to amortize deferred development expenditure. Condition number one, when development is what? Completed. So if you are in the process developing a product, you don't need to amortize the development cost until you are done. That's the first rule. Rule number two, the commercial production been commenced or you started producing the product or using the formula in commercial quantities. That is it. Okay, so that's all for this. That's all for this. Then it tells me that we have to look at this question again. There's a particular question. Now we need to look at it again. So let's see this particular question. I have to scan through. Here, I have to scan through. Let's look at this question. Okay, go to note 3. I think I have to solve this question. Note 3. In addition to capitalized development expenditure of 10 million, further, research and development costs were incurred on a new projects, which commenced on January 2009. The research stage of the new project lasted until 31st March 2009. So they started it when the examiner starts something like this, to get it clear, just put everything on normal line. Okay? Yes, put everything on normal line. January 2009 here, then until March. So put March here, 31st, so March is part. How many months? 3 months, right? Okay. 3 months. And incurred result of 7 million of the cost. So research cost is of 7 million. Okay. From that date, the project incurred development cost of incurred a development cost of 400,000 per month. On July 2009, the directors became confident that the project will meet or will be successful and yield a profit well in excess of its cost. The project is still in development at 31st December 2009. Okay, so it means that they are still developing the project. So we have to move it from development started from March, even though it started from March, like June, July there. They were setting in first July, they were certain. So even though development started from here, they were what? Certain in where? 1st July. So from 1st July up to when? December. That is where we can capitalize. That is where we can do what? Capitalize. So that is where we can capitalize. That is examiner. That is where we can capitalize. Okay. So this is what we have to do. First of all, tell the examiner that they've incurred 400 per month. So if you are looking for research cost, over here research cost should be first from January up to March, they incurred, let's say we are working in thousands. So they incurred 700, right? So this is out of 7 million. Second, we get the examiner, March. So they end it in March, but because when they started the development, they were not certain. They became certain on July. So development will start July. So all those costs that we have incurred, it must be expensed as a research cost. So from April to April, May, June. So April to June, which is 3 months. The third examiner, 3 times 400, because they said from there they were incurring 400 cities, right? And that will give 1,200. So therefore, research should be 1,900. Perfect. Research cost is 1,900. Let's go to development. Development, we can say that from July up to December, which is 6 months, right? Yeah, 6 months. So 6 months times 400 Ghana. That should give us 2,400 or so. Okay, so if we get 2,400, then it means that this must be capitalized. So this should be capitalized as intangible. This should be expensed in the P&L. That is all. So they say all the expense, research, and development cost is charged to cost of. So that means don't forget to charge the cost of sales. Okay. Now they say capitalized development expenditure is amortized at 20% using the straight line method. This amortization must move on to or must be charged on the existing one, the one in trial balance already. The one in the trial balance. Capitalized development cost, here is it. 10,000, so that one you charge it on this. Good. Okay, so look at this note. I'm using this particular figure here. Kindly check for me 4,300. They've written research and development cost here, 4,300. This is the composition. If you add 2,400 to that of 1,009, you get 4,300. So in short, kindly send this one to cost of sales as an expense. Cost of sales. Kindly send this one to the balance sheet as what? Development expenditure. That is all. So that is the accounting treatment for this. That is the accounting treatment. Okay, so I believe strongly that we are fine with this treatment. So that is that. Okay, let's go to IAS 37 to solve probably some few questions under it. Okay, but I have to give something to you. Yes, I have to balance the equation. So I am balancing the equation. So take note of this question. So let's go through one after the other, even though it's your trial work. I have to look at them. Let's see. In all, you are looking for the accounting treatment, even though there's a question in here. We have to look for the accounting treatment. Let's see. Come copy. They are saying that Dexterity Co. is a publicly listed company that has been considering the accounting treatment of its intangible assets and how the matters below should be treated in its financial statement for the year to 31st December 31st March 2014. Please, that is a requirement. Determine the accounting treatment in a financial statement, that is all. On 1st October 2013, the company acquired Intangible Co., a small company that specializes in pharmaceutical drug research and development. The purchase consideration was by way of share exchange, valued at 35 million. The fair value of Intangible Co.'s net asset is 15 million. Goodwill is for 20. Excluding any item referred to below. Intangible Co. owns a patent for an established successful drug that has a remaining life of 8 years. A firm of specialist advisors, Lead Brand, has estimated that the current value of the patent to be 10 million. However, the company is awaiting the outcome of clinical trials where the drug has been tested to treat a difficult illness such as COVID-19. If the trials are successful, the value of the drug is then estimated to be 15 million. Okay. Also included in the company's statement of financial position, 2 million for medical research that has been conducted on behalf of the clients. Perfect. So tell us the accounting treatment of this. So let me hear from you the accounting treatment of this. First of all, they say the financial position also include 2 million for medical research. Financial position should not contain research. So tell them that totally this research should be taken off from the financial position and send it to the P&L immediately before you close your eyes and open it. They must do that. I have to do them for them. Good. Line by line. But here we start from the last line because see. Okay, so here in short, if I should put the asset down, the company bought an asset and then which have they paid 35. Meanwhile, the net assets, the tangible ones is 15 million. That is the fair value of the tangible 15. The intangible is in here. They're giving us patent to be 10 million, but are waiting for clinical trials. So how do you treat this? And then again, if the drugs are successful, the value of the drug is then estimated to be what? 15 million. So that is that. So in short, how do you treat this particular transaction? Yes. You can solve this very well if we have gone through public consolidation, a bit of consolidation, to just know the difference between the fair value of the consideration and the total fair value of the net assets acquired. That's the goodwill, and it must be recorded as intangible asset. However, assessing the intangible asset for acquisition purposes, we have to look at it again. So that is that. Now what we'll do is just be trying it. This question will be solved for you. Yes. I remind you when we start acquisition, so take note of that. In fact, let's solve it together. Okay, now let's solve it together now. On October 1st, 2013, Dexterity Co. acquired Temerity. So Temerity Co., a small company that specializes in pharmaceutical drug research and development. The purchase consideration was by way of a share exchange valued at 35 million. Fine. The fair value of the company's net asset was 15 million, excluding the items referred to below. So meaning, and these are the intangible assets. Okay. The company owns a patent for an established successful drug, a patent that has a remaining life of 8 years. Okay. Good. A firm of specialist advisors, Lead Co., has estimated the current value of this patent to be 10 million. So therefore, this is part of intangible assets. Let's go to the board and do something here. Now, we are looking for the goodwill, or you're looking for the assets acquired by the entity. So the assets acquired by the entity, to get it, then examine that here we are looking for those that should be part of assets. So according to the first note, the purchase acquisition. So first, that examiner, I, purchase consideration. But let me shift it here some more. Okay, like right now this side, I like here. So I, acquisition of Temerity, and we are calculating the goodwill of it. goodwill. First, tell us the purchase consideration, fair value of what? Purchase consideration, how much you paid. Let's work in thousands of dollars. So, thousands of dollars, you pay $35,000. Less the net assets, that doesn't mean less the fair values of the net assets acquired. So list all the net assets. Start from patent. So let's start from the patent, which happened to be $10,000. I put 3 zeros on top again. So to be $10,000. So let's continue the game. Okay, so what happened is this. The 10 million will be part of the cost of the patent, which is an intangible asset. We are just listing which of these should be an asset and which of these should not be an asset. That is all we are looking for. Now they are saying that, however, the current value is what? Is 10 million. However, the company is awaiting, the outcome of clinical trials where the drug has been tested to treat a different illness. If the trials are successful, the value of the drug is then estimated to be what? 15 million. So that means if accepted, the fair value of the drug becomes 15, not the 10 million we stated in there. Okay. So how are you going to treat this in the books? Here we have to capitalize the patent for the following reasons. Because the patent for the new drug and the license, it will generate what? Future economic benefits. So it must be part of the asset. It must be part of the asset because it satisfies the criteria of what? Or it meets the criteria of IAS 38. That is the intangible assets. So take note of that. So we should take note of that. Right here, at what amount? Is it at the current value or the fair value? So here we have to use the fair value. So here we use the fair value of what? 15 million. What is the fair value of 15 million? That is all. Instead of the 10,000, so fair value of 15 million. Okay, that's the patent. Then there's another asset that we probably jumped. That asset is in here, 15 million. That is we can call it what? Net asset. Okay, so we can do it this way. So less the fair value of net asset, which is 15,000 plus the patent. Fair value is 15,000. We don't acquire the book value of an asset. We acquire the fair value. is 15 million. So 15 million, and we've risen 3 zeros on top here. So 11 got 15,000. So at the end of the day, the total cost net asset will be 30,000, right? Against a purchase consideration of 35,000. So therefore, 5,000. That is a good roll. So here, I just want to know how to treat this patent. Tell the examiner that the patent should be part of the assets. That is all we are interested in. Tell the examiner to be part of this asset. However, the 2 million must be expense. The 2 million, which is on a financial position, should be what? Expense, because a research cost. That 2 million is what? A research cost. 6 million should be expense. Where the research cost? Yes, this 2 million. So just tell them that. So let's go to number 2. The company has developed and patented a new drug. They have what? Developed and patented a new drug, which has been approved for clinical use. The cost of developing the drug were 12 million. Based on early assessment of its sales success, lead brand have estimated its market value to be 20 million, which can be taken as reliable measurement. Can they go ahead? This is a clear case. This is a clear case of what? Internally generated intangible asset. Now we are saying that if you can separate the cost of the internally generated assets or intangible assets, then go ahead and capitalize. So here they should capitalize fast. They should capitalize it in their books. At what value? At what value? So here they have to just go by the entities. They have to go by the entities measurement. So initially, it must be stated at what? At cost initially. Then subsequently, they can decide to use either the cost model or the revaluation model. Okay. The cost of the development of the drug were 12 million, based on early assessment of what? Sales success. Okay. The brand have estimated that its market value is at what? $20 million, which can be taken as reliable measurement. So it's reliable. So therefore, we can record this as intangible asset. So we are just asking whether they should treat this as intangible asset or not. They should go ahead, because this will generate future economic benefit. Why? Because it will produce an inflow. But it's a sales success here. Fine. So that's the end of the point 2. Point 3. The company manufacturing facility have recently received a favorable inspection by government medical scientists. As a result of this, the company has been granted an exclusive 5-year license to manufacture and distribute new vaccine. Wow, new vaccine. If it's for COVID-19, so they should capture it fast. They should do what and record it. Although the license had no direct cost to the company, eight directors feel it is granting. Eight directors feels it's granting. It's new. Great. Let's take that again. They're saying that although the licenses have no direct cost to the company, a directors feel this license is a reflection of the company's standing and have asked the lead brand, to value the license accordingly. They have placed a value of 10 million on it. So the question is, should you record the license as intangible asset? Just yes or no. That's all. So should you record it? Friends online. License for new vaccine. Yes. Capitalize it as what? Intangible asset. So third examiner, the license for the new vaccine should be capitalized at the value stated. That is all. At the stated amount. Why? Because it meets the criteria. Meet the criteria. Okay. Let's go to point 4. In current accounting period, the company has spent 3 million sending its staff on specialist training courses. Whilst these courses have been expensive, they have led to a marked improvement in production quality, and staff now need less supervision. This in turn has led to an increase in revenue and cost reductions. The directors of the company believe this benefit will continue for at least 3 years and wish to treat the training cost as an asset. Can I go ahead? The training cost. This one, everyone have to answer me. Training cost. So friends online, the company have trained their staff and they've incurred 3 million. And because they've spent a lot and the benefit will last for 3 years, can they go ahead? Okay, so tell us if they should go ahead with training cost. Okay. Yeah, any training cost should be expensed. That's all. Training cost to be expensed. All the training cost should be expensed. So take note of this. So basically, that is the game. Okay, so on that note, probably we will end the intangible assets, and then move on. But there's a particular one that you need to do it for me. Then I'll upload it for you, so you can check on the platform. It has landed safely. Okay, so now this is how far the good Lord will bring us for that of intangible assets. Great. So join us again for the IAS 37 question solving. Provisions, question solving. So let's go to provisions, question solving. Okay, so basically that is that. Perfect. Kindly subscribe if you have not done that, and you can join us for the question solving stage.